Hey there. So you're running an LLP or maybe thinking about it? Awesome. But let's talk about something super important, the accounting. It might sound a bit dry, but getting this right is the secret sauce to building a solid business. We're going to break it all down for you, step by step, like a simple roadmap. No jargon, just what you need to know. Yeah, this one's for you. LLPs are amazing, right? They're so flexible, but, and it's a big but, that freedom comes with some serious financial duties. These aren't just suggestions, they're rules you gotta follow. So what are they exactly? Let's dive in. Okay, here's our game plan. First, the basics, keeping proper books. Then we'll talk about the big one, the annual statement. After that, we'll answer a super common question: when do you actually need an audit? And finally, we'll wrap it all up with a handy compliance checklist. Simple as that. All right, let's jump into step one, keeping proper books. Seriously, think of this as the foundation of your entire business house. If this part is shaky, everything else we talk about today could come tumbling down. It is that important. So, when the law says proper books, what does that even mean? It's way more than just a shoebox full of receipts. Your records have to tell a complete story. They need to be so clear that anyone can see every transaction, understand your financial health at a glance, and, crucially, make it easy for your partners to fill out the official paperwork later. It's all about being accurate and totally transparent. Okay, let's get practical. What actually has to be in these books? Well, first, all of the money coming in and going out, and you got to explain why. You need a list of all your assets, that's the stuff you own, and all your liabilities, the stuff you owe. If you sell physical products, you've got to track everything: what you bought, what's on the shelf, what you're currently making, the whole shebang. It's really the full financial picture. Now get this is the one that catches so many people out. You can't just shred these records after the year is over. No way. You are legally required to hang on to your books for 8 years. Yep, 8. Why? So if any questions pop up years later, you've got the proof. A good, safe storage system isn't just a nice to have, it's a must have. Okay, so you've been a rock star all year, keeping perfect books. Now what? Well, that brings us to step 2, the annual statement. This is basically where you take all that hard work and wrap it up in a nice, official package for the government. It's your LLP's big yearly check-in. I love this analogy. Think of it as your LLP's annual report card. For real, it sums up how you did financially for the whole year, and you hand it in to the principal, in this case, the registrar. It's your way of showing the world, hey, we're doing great, we're healthy, and we're following the rules. Okay, the fancy official name for this report card is the Statement of Account and Solvency. And listen, every LLP, no exceptions, has to file one of these every year. The whole point is to publicly show your finances. And this is key, to prove you're solvent. All that means is you have enough money to pay your bills. Simple as that. The good news is, filing this thing isn't rocket science. It's just 3 steps. 1, you fill out the right form, which is called Form 8. 2, your designated partners have to sign it. This is them putting their names on the line, saying, yep, this is all true. And 3, you get it to the registrar on time. That's it. So let's just nail down these details one more time. The form, Form 8. Who signs? Your designated partners. And the deadline? This is the one you cannot miss. You've got 30 days after the end of the 6-month mark following your financial year. I know it sounds complicated, but just figure out that date and put a giant red circle around it in your calendar. Seriously. Okay, moving on to step 3. We've talked about keeping books and filing statements. Everybody has to do that. But now there's this other thing called an audit. And this is where people can get a little confused. The key thing to know is it doesn't apply to every LLP. It all comes down to how big your business is. So let's just ask the question head on, the one every LLP partner wonders about. Do we have to pay for a professional audit? And the answer, which might surprise you, is not always. Let's find out when you do. Thankfully, the rules here are super clear. There are just 2 magic numbers to watch out for. And remember, it's an either-or deal. If your turnover, your total sales, goes over 40 lakhs in a year, ding, 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 you need an audit. Or if the total contribution, the money partners put in, goes over 25 lakhs, you also need an audit. Hit just one of those and an audit becomes mandatory. Okay, but what if you're looking at those numbers and thinking, whew, we're not even close? Great, that means you don't have to get an audit. But hold on, it's not a total free pass. You're not off the hook entirely. You still got a couple of important things to do. So if no audit is required, the responsibility basically lands right back on you, the partners. Inside that same formate we talked about, you have to add a special statement. You're essentially raising your hand and saying, we know the rules and we swear we followed them and prepared our books correctly. You're certifying it yourselves. And hey, just because it's not required doesn't mean you can't choose to get an audit. It can be a great way to get peace of mind or look more credible to a bank. Phew, okay, that was a lot. We've gone from the day-to-day bookkeeping all the way to annual filings and audits. So let's wrap this all up. Let's pull everything we've talked about into one simple, final checklist for you. All right, here it is, your whole compliance roadmap in 5 easy-to-remember points. 1, keep detailed books, always. 2, hold on to those books for 8 years. 3, file your Form 8 on time every single year. 4, watch those 2 magic numbers, 40 lakhs turnover, 25 lakhs contribution, to see if you need an audit. And 5, if you don't need an audit, make sure you file that statement of responsibility. Got it? That's the whole game right there.
You know, every business needs a referee, right? Someone to look at the books and make sure everything's on the level. Well, for a limited liability partnership, or LLP, that referee is the auditor. Today, we're going to walk through their entire journey, how they get the job, how they leave, and what happens when the financial rules get broken. Let's dive in.
It's a really important question, isn't it? Who keeps a business honest? So often, the answer comes down to an independent auditor. Their whole job is to make sure the financial story a company is telling is true and fair. And for an LLP, this isn't just a good idea, it's the law.
So who can even be an LLP auditor? The law is super specific about this. It has to be a practicing chartered accountant. Their whole mission is to be a kind of financial watchdog, independently sniffing through the LLP's books to protect everyone involved, from the partners to the public. They're basically the guardians of financial integrity. So here's our game plan. We're going to follow the auditor's journey from start to finish. We'll kick things off with how they get appointed, then we'll cover what happens when they leave. After that, we'll get into the super important annual filings, see what information is actually public, and wrap up with the very serious price of dishonesty.
All right, first up, bringing that watchdog on board. An LLP can't just pick a name out of a hat. The whole appointment process is really structured and full of rules, all designed to make sure the person they choose is qualified and properly put in place.
And here is the absolute foundational rule. The only person qualified to be an LLP's auditor is a chartered accountant who is currently in practice. This isn't just a suggestion, it's the law. It ensures you have a high standard of professional skill right from day one.
You see, appointing an auditor isn't just a one-and-done thing. The designated partners, the ones on the hook for legal compliance, have to act in 4 different scenarios. They have to appoint the very first auditor before the end of that first financial year. Then, for every year after that, they've got to make a new appointment at least 30 days before the current year ends. They also have to step in and fill what's called a casual vacancy, like if an auditor suddenly resigns, or if an auditor gets formally removed. Okay, so that leads to a pretty good question. What if that deadline flies by and nobody appoints a new auditor? Does the LLP just not have one? Well, no. The system actually has a pretty clever default setting to stop that from happening. The system has this neat little trick. If nobody does anything, the current auditor is automatically considered deemed reappointed for the next year. It's a safety net to ensure there's always oversight. Now, this automatic renewal only gets stopped in 2 cases. 1, if the LLP's own agreement says you have to do a formal reappointment every time, or 2, if a majority of the partners decide they want to change and they give official notice. Okay, next up is the departure. What happens when that relationship ends? Well, an auditor can't just ghost the LLP. The whole process is governed by specific rules, whether they're being removed by the LLP or they decide to resign on their own. So the process really depends on who's kicking things off. If the partners want to remove an auditor, they have to follow whatever procedure is laid out in their LLP agreement. And if the agreement is silent on it, they need every single partner to agree, unanimous consent. On the flip side, an auditor can resign just by giving a written notice. But, and this is a big but, that notice comes with a very important string attached. This is so important. An auditor can't just quit and say nothing. Their resignation notice is legally useless unless it includes a statement explaining why they're leaving. Think about that. It's a massive tool for transparency. It means if an auditor is leaving because of a disagreement, or they're being pressured, or they found something sketchy, that reason has to go on the official record. So, with the auditor in place, we get to their big yearly task, which is all tied to the LLP's own reporting duties.
You can think of the annual return as the LLP's official report card for the year. It's a key document.
This is totally non-negotiable. Every single LLP, no matter how big or small, has to file what's called an annual return, or Form 11, with the registrar. It's just a fundamental part of being a legal, compliant business.
But here's where things get a little more nuanced. While everyone has to file, not everyone's form needs the same sign-off. The rules actually change depending on the financial size of the LLP. It's a pretty practical approach, really, adjusting the rules based on the scale of the business.
So it all comes down to two key numbers: a total turnover of 5 crore rupees and a total partner contribution of 50 lakh rupees. Where an LLP stands in relation to these thresholds determines who has to certify their annual return. And here's how it works. If an LLP is below both of those amounts, a designated partner can certify the annual return. Simple enough. But if it goes over either one of them, turnover or contribution, then the return has to be certified by a practicing company secretary. That adds an extra layer of professional review for the bigger operations.
And what happens if an LLP just doesn't file? Well, the consequences are financial. The penalty starts at 10,000 rupees but can go all the way up to 1 lakh rupees. So yeah, they make it very clear this is not optional.
This brings us to our final section, and it really ties everything together. You see, all these rules aren't just for some internal checklist. They're part of a bigger system of public transparency, and it has some really severe consequences for anyone who tries to cheat it.
A core idea here is that LLPs operate out in the open. This is not some private club. Key information about the LLP is filed and made available for literally anyone to go and look at. This transparency is what builds trust in the whole business environment.
So what can you actually go look up? Well, here are the key documents on file. You can see the original document that created the LLP, you can see who the partners are, and you can look at critical financial filings like the Statement of Account and Insolvency and that annual return we were just talking about. It's a clear public paper trail.
So, because these documents are public and people rely on them, the law takes a very, very dim view of anyone providing false information. If you knowingly make a false statement or leave out a critical fact on any of these filings, it's not just a clerical error, it's a serious offense.
And the consequences are not just a fine. A person found guilty of making a false statement could face prison time for up to 2 years. That really elevates this from a simple compliance issue into the realm of criminal activity.
And on top of potential jail time, the financial penalties are huge. We're talking a mandatory minimum fine of 1 lakh rupees, but it can stretch all the way up to 5 lakh rupees. The whole system is designed to make one thing crystal clear. The cost of being dishonest is way, way higher than any benefit you could possibly get.
Diving deep into the rulebook for limited liability partnerships, or LLPs.
Have you ever wondered what actually happens to that mountain of paperwork every single business has to file? Well, today we're going to follow the complete life cycle of an LLP document. We'll track it from the very beginning, when a powerful authority asks for it, all the way through its years in storage, right up to its final official destruction.
So our story really begins with the registrar. You can think of this role as the official guardian of LLP compliance. They've got some pretty significant powers to make sure every single business is playing by the rules.
Okay, so how exactly do they do that? Let's get into the details. Think of the registrar as a kind of corporate detective. Their main tool, right out of Section 38, is the power to demand information. And I mean anyone connected to the LLP, whether they're a current partner or someone who left years ago. The goal? To make sure everything is totally transparent and above board.
Now, this isn't an immediate jump to the most severe action. It's actually a very clear step-by-step process. It starts with a formal request for information. But if that reply is late, or it's incomplete, or frankly just not good enough, then the registrar can escalate. And that means they have the power to summon that person to appear and provide the information they need face-to-face. And yeah, there are some pretty serious consequences for not complying. If you fail to show up for that summons and you don't have a lawful excuse, you're looking at a fine. It starts at a minimum of 200 rupees, but it can go all the way up to 25,000. So you can see, this is not something to be taken lightly.
Okay, but what about situations where the rules are broken, but it's not a massive crime? You know, what if an LLP commits an offense that's only punishable by a fine? Well, there's a specific and pretty efficient way to handle this. This is where we get into something called compounding of offenses. The easiest way to think about it is like a settlement. Under Section 39, for those offenses that are only punishable by a fine, the central government can basically settle the matter. They collect a sum of money from the person who's suspected of the offense, and that's that. It's a really practical way to avoid a long, drawn-out legal battle.
All right, let's switch gears. So a document has been filed with the registrar. What happens next? It doesn't just get shoved into a drawer and forgotten. Nope. It enters the next big phase of its life, preservation. It becomes part of the official archives, like a corporate time capsule.
And you should know, not all records are created equal. The law is super specific about how long different types of LLP documents have to be kept. This isn't just some random timeline. It's all based on how important that document is for the LLP's legal identity, its financial history, and its overall compliance.
Okay, this table here is absolutely crucial, especially if you're a student trying to get your head around this. Look at the breakdown. The really foundational stuff, like the incorporation document, that's kept permanently, forever. Then you have liquidation papers, which stick around for 21 years. The bulk of the annual filings, like returns and statements, they're kept for 5 years. And then the everyday stuff, like routine emails about fees, just 3 years.
Now let's focus on that 5-year category for a second, because it's a big one. This covers the real core compliance and annual filing documents. We're talking about annual returns, statements of account, legal papers, consent forms, the whole shebang. These are the documents that prove the LLP is running properly year after year.
But here's the thing. A document's story doesn't just end in the archives, collecting dust forever. After it's lived out its legally required lifespan, it reaches the final, formal chapter of its existence.
And that brings us to the very end of the line. We're talking about clearing out the archives. This is the final chapter, the sanctioned, official, and very carefully documented destruction of old records.
Now let's be clear, this isn't just someone grabbing a shredder and going to town. Rule 27 lays out a very formal, very regulated process. First, records can only be destroyed after their preservation period is over. Second, it requires a specific order from the registrar. And maybe most importantly, the registrar has to maintain something called a Register of Destroyed Documents. This is a permanent log that certifies exactly when and how everything was destroyed, ensuring total accountability.
This quote from the rule itself really hits the point home. It says the registrar shall maintain a register of destroyed documents and shall certify therein the date and mode of destructions. This just underscores how formal the whole thing is. It's all about creating a clear, unbroken chain of accountability, right? Every single step, from creation to destruction, is tracked. So when you step back and look at this whole system, why does this highly structured life cycle for a business record even matter? Well, it really all boils down to a system built on transparency, accountability, and of course, legal certainty. So let's just quickly recap the key takeaways here. The registrar has some serious tools to investigate and keep LLPs transparent. Record keeping isn't forever. It's this smart tiered system based on how important a document is. And both preserving and destroying records are formal, rule-based processes. And finally, there are mechanisms like compounding to handle minor offenses efficiently. The big picture is that this whole framework protects an LLP's history and keeps it accessible while also managing it efficiently.